Afternoon, everybody. How are we doing today? Welcome, everyone. If I can get a quick audio and video check here, just to let me know that we are coming through loud and clear, that you can hear me and see the screen. Hello, Ed, Paul, how you guys doing? Hey, Sandra, Arthur, Omar. All right, good. Okay, let me get us moving here. Hey, Mr. Mike, how you doing up there in Dallas, Texas? Glad to have you guys with us once again. Good to hear it. Hey, William. All right, well, let's get moving. Hello, Patty, welcome. And let me get our recording going here, and we're going to move right along. Okay, welcome everybody to the Nadex Application and Strategy webinar series. My name is John Skelton. I'm with apexinvesting.com, and this webinar today is brought to you and hosted by Nadex. And today we're going to talk about we're going to do a back to the basics with Nadex spreads. If you've been with us recently, we've talked a lot about Nadex binaries, and we've reviewed the basics of binaries, and we've talked a little bit about different binary options to choose and how they work and how they're priced and so on. Now we're going to flip over a little bit and talk about Nadex spreads. Been a little bit since we've talked about them. We're kind of doing a back to the basics rotation here, and we've got a lot of you guys have been with us for a while, been with Nadex and been trading for a while. So for some of you veterans, this webinar today might be very basic and very elementary. But you also have to realize we've all been here, and we were once brand new as well and didn't even know what a spread was or how it worked. And we've got a lot of new people with us, and a lot of new people that are new to Nadex, and a lot of people that understand, hey, I know Nadex offers mainly two products, binaries and spreads. Maybe I'm familiar with binaries, maybe I'm not. But a lot of new people are familiar with binaries, but they don't quite understand spreads. Cheryl says, I'm a new demo trader looking forward to this. Great, Cheryl, perfect. So what this is going to be is kind of a brand new, you've never even heard of a spread, you don't know what it is. It's kind of going to be a, hold your hand and walk you through exactly what is a spread. Here's the basics 101. What are they? How do they work? And so on. And then over the next several weeks, we're going to kind of build on this. So today we're going to talk about what is a spread, how does it work, very basic, and then we'll talk about, okay, why are there different spreads on the Nadex platform? How does each one work? Why are they different? Kind of build on it. So today is foundation. So if you're, again, if you're brand new or if you've only traded Nadex binaries, definitely recommend you taking a look into Nadex spreads and start understanding them. Maybe you trade binaries every day live in your live Nadex account. Well, take a peek at Nadex spreads. Start checking them out in your demo account and see how they work out for you, and start taking a look at them each day. So let's knock out our disclosures so we can move forward. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. And any examples here are not a recommendation to buy or sell or a solicitation to buy or sell futures, options, bonds, binaries, Nadex spreads, or securities of any kind. Also keep in mind that any potential order entry that I show you today is in no way a advice. It's in no way a trade recommendation. It's completely and simply me, showing you the Nadex platform, explaining to you and educating you on how to open an order ticket, how to enter an order, and it's completely just for informational and educational purposes only. Any trading decisions you make, your sole responsibility. And as always, past performance not indicative of future results. So, like I was just mentioning, if you're brand new to Nadex, I just want to take a moment here and walk you through a couple of very important things. And if you hop on over to the Nadex platform here, just go to nadex.com. A couple of key things here you need to know if you're brand new. And first of all here, if you go to trading platforms, right here you can go through the binary options tab, go through the spread tab. Today we're going to be talking about spreads, but some great basic information here, and even some, even more in-depth, past basics, some really great education here. The one thing I really have to give Nadex a ton of credit for is the amount of education and free tools that they give you, okay? And you can go through here and get some basics of what are binaries, benefits, you know, why Nadex, spreads, what are spreads, some of the benefits. But if you hop on over here to the Learning Center, right here, this first tab here, webinars, this will let you know what upcoming webinars are going to be taking place. Like right now, we're on this webinar right here, back to the basics with spreads. You can see, you know, what are some of the upcoming webinars in the future. Like I said, today we're covering, you know, the basics, and then, you know, next week we're going to talk about, hey, now that you have the basics down, here's some common mistakes with spreads that people, you know, that people make. Now that you have an understanding of what it is, here's some things to make sure you don't do. You know what I mean? So you can see what upcoming webinars there are and get registered for those. And then right here under Webinar Archive, very, very important. If you've missed any of the past webinars, you can go back, and this is where all the recordings will be. For example, today's webinar is being recorded, and this is where it will be posted if you want to go back and watch it again. And something you can do right here, filter by presenter. If you just click this drop-down box, you'll find us right here, Apex Investing Institute. You'll be able to see all of our past webinars. And, you know, for example, like I said, you know, we talked about the basics of binaries. We talked about the difference of short-term and long-term binaries, top mistakes with binary. Again, there's a ton of information here for you to build from the basics to common mistakes, choosing the right binary, different strategies, you know, trading morning breakouts, you know, trading spreads, trading binaries, just a whole wealth of knowledge and information here in this library. And again, some, you know, under the Learning Center, you've got trade examples, videos, handbooks, FAQs, just a ton of free education there. So definitely take advantage of this free education that Nadex offers you. Another huge tool, which in my opinion is an absolute must for anyone. If you go right here to trading platforms, Nadex has, you know, the online trading platform. They also have a mobile app that you can put on your phone, and, you know, you can trade mobile. You can, you know, monitor your open positions mobile. Right here, demo trading platform. If any of you do not have a demo account, get one of these. In fact, do it right now. Do it right now while we're on the webinar. All you've got to do is just select a username, fill out some quick information, and hit Open Demo. Nadex will give you a $25,000 practice demo account. All right. All you got to do is submit that information, and in just a few moments, you'll get an email from Nadex with a temporary password, and you can log right in to the Nadex demo account. Once you've done that, you can go right here to the My Account tab and go right here to Settings and then Password. That will let you change the temporary password over to a password of your choice that's easy to remember, okay? And what happens here is the demo account is great because it allows you to get familiar with Nadex, familiar with the Nadex platform, be able to go through all the different options that Nadex offers for you. And, you know, what are the different instruments and different expirations, how to open tickets and submit orders. It's just a great place to get familiar with the platform with demo money as opposed to live money. It's also a great place, again, if you're brand new, just to get some practice. If you're testing out a new strategy, testing out a new system, don't jump in and use your live money to test a potential theoretical strategy or system, right? That's a very expensive way to learn, okay? Use your demo account to test out anything new, all right? And any new strategies and systems, get them, you know, mastered in demo before you go over to live. Or like I said, if you have a live account and you're already trading live, but you're only trading binaries, for example, but you're interested in spreads, trade spreads in demo until you get them down, all right? Whatever strategy or system that you're using, and you get an entry on that system, and you normally take entries with binaries, well, do that. But then in your demo account, maybe take some spread trades, see how they work out, check your risk and rewards, and so on, okay? So check those out and definitely hop in and get a demo account there. Okay, Patty real quick says, how do we find an old demo account? A couple things here, Patty. I know if you're like me, I forget my passwords all the time, right? So a couple things you could do here. Just hop on over to nadex.com. And when you go to the login page here, right here, forgot your login details. Maybe you know what email address or username you were using, but you forgot your password. You can just click forgot your login details there. Okay, and so start there, Patty. Okay, you think you found it, but yeah, if you ever forget that, just start there. And worst case, if you can't get it through here, if you have to call customer service, you can. But this is the easiest, quickest way. You don't have to make a phone call or wait on hold or what. Just pop it in there and shoot it on over to you. They'll get you a new temporary password, and then you can log in and change it. Okay. Let's see here. Cheryl, for later, how do I know the price that I'm paying for a U.S. Tech 100 spread when it is in, for example, in max profit? Okay. Actually, we'll review that, Cheryl. Actually, some of these examples we're going to go over should answer that question for you. So hop on over, take advantage of all the free tools that Nadex offers you. Again, I'm with apexinvesting.com. Apex and Nadex, two complete different separate companies, okay? Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We've got over 20,000 members. We've got, trade rooms and strategies and systems and indicators, but we focus a lot of our strategies focus on risk management and probability. So that's why we love the capture risk products with Nadex. And we're traders just like you. We trade Nadex binaries and spreads all the time and every day ourselves and in our room. And, we do these application and strategy webinar series for Nadex. What these webinars are for is to get you familiar with Nadex, help you understand who is Nadex, what products do they offer, how can I utilize those products, binaries and spreads into my day-to-day trading. So there are different ideas and different ways to trade them. So it's just some free education for you. I've been with Apex now for about 3 years as head of operations. I've got a background as a stockbroker and in the banking industry. And once again, I'm a trader just like you. So that's what we're here for. And let's hop right in. So today, Nadex spread basics. What is a Nadex spread? What's the value of a spread? How do they work? Why trade them? How to trade with reduced risk? And how to trade in any market condition around the clock with Nadex. Okay, so again, starting from a very basic elementary view. I don't know what a spread is. I've never heard of a spread. What is it? Well, I used to like to call them box spreads, okay, because they look like a box if you draw them on a chart, all right? And I'm going to show you examples of that. And imagine a chart, imagine a box, and there's a top and bottom of this box, or like in a house, there's a floor and a ceiling, okay? So just keep that concept in mind. Now, I want to start off by saying, if you are a binary trader, if you're familiar with how binaries work, okay, I'm going to make one example probably in the next webinar about binaries and spreads, but what I need you to do is just press the reset button, okay? Do not try to think about spreads like you think about binaries. They work nothing like a binary except for the fact that they have an expiration and they're on Nadex, okay? So do not think like a binary trader. Do not think spreads are like binaries. Forget 0 and 100, okay? Don't think of floor and ceiling as 0 and 100. Just wipe your slate clean from binaries and what you think you know. Spreads are a complete separate product. They work completely different, okay? So that's the first best tip I can tell you. If you want to understand spreads, forget binaries, okay? Because they don't work the same at all. And if you think they do, or you try to make yourself think they do, or you try to find the correlations, as far as the basics go, there are some correlations later, but as far as the basics, just forget that, okay? With the spread, the price is driven by the underlying market. It's not driven by supply and demand of the spread as the market makers, making the market based on where the underlying is located. Spreads in, forex spreads move in pips. Future spreads move in ticks. which is the last digit quoted. Okay, and every tick is worth $1 per spread, bought or sold. Okay, what do I mean by that? Well, we'll get to it. Anything on the Nadex spread or the Nadex exchange, you know, binaries or spreads, we're talking about spreads, all products are capped risk. You cannot lose more money than you put up to get into the trade. So your risk is the initial amount of money you put up. It's the cost of the trade entry. All right, you can trade stock index futures, commodity futures, or the cash forex market. Okay, so how do spreads work? All right, once again, anything you know or think you know about binary options, just erase it, press delete, start fresh here. So spreads have a floor and a ceiling. Okay, floor is the bottom, ceiling is the top. All right, this is going to be very elementary. You might feel like I'm repeating myself a little bit here in these next few examples, but I'm going to try to just drill this home to you so you get it. Okay, if you get these basic concepts, spreads make a lot of sense and they're very, very easy to understand. Okay, and they're very simple to trade once you understand them. So let's just say that this was an example of a euro dollar chart. So we've got the floor at 1.2400. We've got the ceiling at 1.2500, just as an example. All right. So the spread is the difference between the floor and the ceiling. Okay. This particular spread happens to be 100 pips. There's spreads out there that are, you know, 200 pips, 250 pips, 500 pips. There's, you know, different spreads have different floors and ceilings. So just because this particular example happens to be 100 pips, don't in any way wrap your mind around just like a binary worth 0 or 100, top or bottom. No, 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 no. Okay? It's different. All right? This one just happens to be 100. So in no way equate that to a binary because there's all kind of different spreads with Nadex and all different widths. So the spread is the difference between the floor and the ceiling. It moves in pips or ticks, which is the last digit quoted. Okay? Each pip is worth $1. And in this particular example, there are 100 pips. Okay? So, yeah, Reno, I'll go over that with you here real quick, or here in just a few minutes, okay? Very, very simple way. Rena asked, who decides the floor and ceiling? Okay, it's very, very simple. I'll show you exactly how that's done, and you'll basically know exactly, you know, upcoming here, how that's determined, okay? So, it moves in pips or ticks, which is the last digit quoted. Each pip is worth $1. In this particular example, there are 100 pips. So, spread value totals 100 pips. Each pip is worth $1. So, if we're selling the spread, okay, that means that we're going short, right? We think the market's going down. So, whatever our chart and indicators are telling us, whatever strategy or system that we're using, we think the market's going down. We want to go short. We want to sell. All right? Well, each spread has a floor and a ceiling, right? I can't lose additional money above the ceiling, and I can't get stopped out. I can't make additional money below the floor. So the floor and the ceiling is my top and bottom here. What do I mean by that? Well, if I want to sell, I'm saying that the market's going down, right? Well, what if I'm wrong and the market shoots way up? We've all had that happen, right? We've all entered a trade and we've, you know, gone the wrong direction. Right? We've all done that. Okay, so let's say that we want to go short. We think that the market is going short. Okay, and the market turns against us. All right, let's just say, let me pull a chart over here. Let's just say that, we were trading the Russell, right? And let's say that right here, we thought that the market was going down. We thought the market was going short. But we were wrong, and the market takes off, and it just shoots way up hundreds of pips, hundreds of ticks against us. Well, if, we were trading, futures, or if this happened to be a forex chart, we're losing every single tick that market goes way up against us, right? Or what happens if, we want to go short thinking the market's going down, and there's some huge news event, some big flash crash, and the market just shoots hundreds of pips against us. Well, we just lost quite a bit of money, right? Because it just shot against us. And we, in a sense, have unlimited risk because it could just keep going and going and going against us unless we get out, right? Well, that's the difference with a Nadex spread, okay? And let's take a look here. I can't lose additional money above this ceiling. So what that means is if I think the market's going down and I want to go short, and let's say that I sold at 1.2490. So again, the top or the ceiling of this spread is 2,500. Well, I can't lose, and I think the market's going down. So I sold right here. If I'm wrong and the market goes up instead of down, I don't lose any money above 2,500. It caps my risk, right? So the ceiling is 2,500. I'm selling at 2,490. So what is my total risk? What's my maximum possible risk? Well, 2,500, which is the ceiling, down to where I sold, 2,490, is 10 pips, right? And each pip is worth $1. There's 10 pips. So my cost to get in this trade and my maximum risk is only $10. Okay, does that make sense? Any questions on just that particular part? Let me throw this out. If my ceiling is 2,500 and I sell at 2,490 because I think the market's going down, what if I'm wrong and the market shoots up 50 ticks? I'm wrong and it shoots up 50 ticks. How much would I be down? How much would I lose if this spread expired and it went against me 50 ticks? Okay, remember, each pip or tick is worth $1. Okay, it shoots against me 50. Okay, we've got a couple of mixed answers here. All right, because I kind of threw you a loop there. All right, so if I sell right here at 2,490 and it goes against me 50 ticks, yes, each pip or tick is worth $1, but where is my risk capped? I have a floor and a ceiling. I can't lose additional money above the ceiling. Okay, so Sandra and a couple of people, so if I sold at 2,490, what's the difference? The ceiling's 2,500. I sold at 2,490. So there's 10 pips, right? From 2,500 to 2,490 is 10 ticks. Each tick is worth $1. So my maximum risk is $10. Doesn't matter if the market goes up 10 ticks or goes up 500 ticks. My risk is capped at that ceiling. Does that make sense? Okay. Because we've got a few examples there. Some people said, oh, $1, $10, $50. It's $1 a pip, and the ceiling caps my risk. So whether it goes 10 ticks against me or 110 ticks against me, $10 is my maximum risk. Okay, everybody understand that? That's very important. And when it says I can't get stopped out, what does that mean? Well, if I sold right here at 2,490, my ceiling's at 2,500. Let's say the market pops up to 2,510. Does that mean, well, the market went past my ceiling, so it knocked me out of this trade? It closes out my trade. No, this trade does not close out until I either close it out or until the spread expires. So the market can go against me outside of the spread, but I can still be in the trade, and then it comes back into the spread and I could still profit. So just because it hits a top and bottom, just because it hits a floor or ceiling, doesn't just automatically kick me out of the trade, which is great, right? Because how many times have we said, oh, I think the market's going down, so I'm going to sell it. But then it pops up against us, and then it comes down in our direction, right? So just because it hits a floor or ceiling or goes outside of a floor or ceiling, it does not just automatically knock us out of the trade, okay? So Cheryl says, I can only lose the difference between where I got in and the floor or ceiling. That's correct. If you're selling, meaning if you're selling to go down, Cheryl, then wherever you sell at, your risk is the difference of where you sell to the ceiling. So, quick example, class. Right here, this example is selling at $24.90. Well, what if I sold at $24.50? What if I happened to sell when the indicator was at $24.50? So if I'm selling at $24.50 and the market goes up against me, what's the most I can lose from $24.50 to $2,500? Yeah, 50 bucks, exactly. Okay. What if I sell at $24.70 and the market goes against me? Right, the most I can lose is from $24.70 to $2,500, so 30. Okay, so it's not real difficult to understand how spreads work. Or when you go on the Nadex platform, right, and you enter a spread trade, and you're wondering, well, how much money do I have to put up for this trade? What's the max amount I can lose on this trade? That's it. It's that simple. That's how it's figured. Okay. In fact, let's pull up the platform real quick here. All right. So if I'm looking at indices spreads, okay, and let's just pull up the Dow, for example. All right, and let's look at these spreads here, 1 to 3. Okay. And let's just say that, let's see here, 21,129. 21, okay. Let's just say that I am looking to sell this spread right here, just as an example. I want to sell one of them. Okay. Where is the ceiling or the top of this particular spread? Because this would be the bottom, right? The floor. This would be the top, the ceiling. Everybody understand that? So the ceiling is at what? 21,075. Okay. Where can I sell it for right now? 21,071. So what's the difference of 1075 compared to 1071? It's 4, right? And look, that's exactly what the ticket tells me. My max loss is $4. Does everybody understand why now? That makes sense, Cheryl? Because some people are like, well, I don't understand. I mean, okay, that one told me only $4, but if I click on this spread and I say I want to sell it, okay, it's $8. And this spread, maybe I want to sell it, and oh wait, $48. Why are all these different? All you have to do is look. Where is the ceiling? Where's the top? 175. Where can you sell this particular spread? 126. What's the difference of 175 and 126? $48. Okay, so is that kind of a few little aha light bulbs, like, oh, okay, I see, that's how those numbers are figured. Okay, and we'll next time on the next webinar, we're going to talk about, okay, why are there different floors and ceilings, and why are they priced differently? Okay, we're going to talk a little bit about that. Okay, so the ceiling and floor are in the same position whether buying or selling. Well, yes. Now notice, Cheryl, there are different spreads. Okay, this particular spread has a floor of 125 and a ceiling 225. This one has a floor of 075 and a ceiling of 175. So there's different floors and ceilings to choose from, okay? But yes, whatever one of those floor and ceiling spreads you select, the floor and ceiling are at the same place whether you're buying or selling that spread. It's just a matter of which spread are you choosing. Okay, there's different ones to choose from. All right, we'll talk a little bit more about that. All right, so does that help you understand a little bit more where the risk and reward numbers come from on the Nadex ticket? Okay, so let's just move along here. So if I sell at $24.90, we understand where our maximum risk is. But there's 90 pips of potential profit, right? Because if I sold at $24.90, saying the market's going down, and the market does go down, okay? Remember, the ceiling caps my risk and the floor caps my profit. So there's 90 pips of potential profit going down to the floor, right? Because I sold at $24.90, my floor is $2,400, so that's a what? Difference of 90 ticks. Each tick is worth $1, so the potential profit is $90. Okay? What if I sell at $24.90, saying the market's going down, and let's say the market shoots down, say I'm right, the market goes down, and the market shoots down 200 pips. Each pip is worth $1. How much would I make on that spread? Sold at $24.90, market goes down 200 pips, each pip is worth $1. Do I make $200? Do I profit on all 200 pips? Right, I can only profit down to the floor. So 90 pips of potential profit to the floor, each pip is worth $1, potential profit is $90. Okay, so now do you understand why I said, okay, yeah, Cheryl, does that make sense? I tripped you up there on purpose. Going, if I sold at $24.90, it went down 200, each pip is worth $1. You think 200, so I tricked you up a little bit there if you understand. Your floor and your ceiling are your caps. Remember at the beginning why I said I used to think of them as boxes, because if you draw them on a chart, it's like a box. You have a top and a bottom, right? You're protected and capped. Okay? So does that make sense? Okay? What if the price goes against 200 pips above the ceiling? Well, if I sold at $24.90, where is my risk capped at? I can only lose money up to where, Cheryl? Up to the ceiling. So if it goes up 10 pips against me, 10 ticks against me, how much do I lose? At $1 a tick. $10. If it goes up 110 against me, how much do I lose? I don't lose anything above the ceiling, no matter what it moves. Okay? Everybody got that? So let's flip the example. What if we're buying the spread? What if we think the market's going up? Okay? It's the same exact logic, just flipped. Okay? So if we think the market's going up, wherever we buy into the spread, we can buy it here, 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 wherever we buy in, okay, and the market does go up, we can profit up to the ceiling. All right? Let's look at an example. So we can't make additional money above the ceiling, but we don't lose any additional money below the floor. And again, we don't get stopped out. Just because the market hits a floor or ceiling, it does not automatically close the trade. We have to manually close the trade, or it will close out automatically at expiration. Okay? So let's just say I buy this spread at 24.10. Okay? Well, so I'm buying, saying the market's going to go up. But as soon as I buy right here at 24.10, the market starts to come up, and then what does it do? Boom, it shoots down, right? So I bought for 24.10. Where is my floor? Where is my limit? Okay, my floor is at 2400. So if I buy at 24.10, the floor is at 2400. That's a difference of what? 10 pips. Each tick, or 10 ticks, each tick is worth $1. Okay, so there are 10 ticks of risk. My max risk is $10. Okay, same example here. I buy it saying it's going up. It goes against me 12 ticks by expiration. How much am I down? If it goes against me 12 ticks, each tick is worth $1. How much am I down? Okay. I buy right here. Okay, no, Omar, I tripped you up there again. Okay. Each tick is worth $1. I buy it at 24.10. The floor is at 2400. What is that? 10 ticks. Do I keep losing money below the floor? No. My risk is capped at the floor. Okay? The most I can lose, if the market goes against me 12 ticks, 112, 212, it can keep going and going and going down against me. It does not matter. I don't lose any money below the floor. Okay? Everybody get that. You really have to understand the top and bottom, the floor and ceiling cap you. They cap your risk. They cap your reward. So if I buy at 24.10, the floor is at 2400. It's 10 ticks difference. That's the most I can lose. That is my max risk. Okay? But up to the ceiling of 2500, okay, that's a difference of 90 pips. If I bought at 24.10, the most I can make is all the way up to the ceiling, okay, which is a difference of 90 pips. So there are 90 pips of profit potential. Each pip is worth $1. So my profit potential on this trade is 90 pips. Okay? So I can close out the spread at any time. So let's say I sold it here and I want to buy it back here. Or I sold it here and I want to buy it back here. Okay? I can get in and out any time, all right, depending on, you know, what the bidder offer price is. Now, if I leave it open till expiration, if the spread expires, it will close at the settlement price at the time of expiration. The settlement price is based on the underlying market. Okay, so I can close it out or I can let it expire. Now, a couple questions here. If I bought this spread at 24.10 and then the market goes up to 24.50 and I want to just get out of it then. I gotta go. I can't wait till expiration. I gotta go. So I bought it for 24.10 and I sell out of it at 24.50. What's the difference of 24.10 and 24.50? 40. So I didn't hold it till expiration. I got out of it early, bought at 24.10, sold at 24.50. That's 40 pips, 40 ticks difference. Each tick is worth $1. So what would my profit be on that trade before fees? $40, right? Okay. Let's say that I bought into this spread at 24.50 when the market was right here. I bought at 24.50 because I think the market's going up. What's the most I could make on this spread? If I bought it at 24.50, the most I can make is 50. Okay? If I bought it at 24.50, what's the most that I could lose? 50. No, Randy, if I bought it at 24.50, okay, and it goes against me, I only lose money down to where? 2400. So what's the difference between 2450 and 2400? 50, right? Okay, so Randy, how about this? If I bought it at 2450, because I think it's going up, but I'm wrong, and the market starts to come down. I buy it at 2450, now it comes down to, you know, I bought it at 50, now it comes down to 45, then it comes down to 40, and then it comes down to 35, and it comes down to 30, it comes down to 25. All right, I think I was wrong. I think the market reversed on me. Do I have to just sit there and watch it go all the way down to the floor and lose the whole 50? Or I'm like, okay, I bought at 50, it's coming down, it's at 40, it's at 30, now it's at 25. Okay, I'm just going to get out now. How much would I be down? I bought at 24.50. When it gets down to 24.25, I'm like, let me just get out at 24.25. What's the difference there? 25. So I'm down 25. Okay, so my maximum risk was 50, right? But if I see it going against me, or my chart, my strategy, my system has flipped around the other way, do I have to just leave that trade on and let it go to max loss? Or can I just get out of it? Jump out of it. And maybe I want to go the other way and sell, right? I want to follow what my chart's doing. Okay, so does that make sense? You have a floor and a ceiling that protect you and cap you, but you can get in and out anywhere in between there. Okay? Now, very, very important. If I bought this spread at 24.10, okay, the market goes down, right? See that? It shot down outside of my floor. Well, the spread hasn't expired yet. Okay, yeah, $10 of my max loss. You got it, Randy. Even though it went way down here, I'm not losing. When I bought at 24.10, I'm only losing down to the floor, and then I'm capped, right? It can keep going and going and going and going. Is it doing anything to me? Am I freaking out? Is my heartbeat going boom, 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 boom with every tick the market's going against me? No, right? What happens if I'm trading futures or spot forex? And right here, I think the market's going to keep going down. So I sell it. But I'm wrong, and it's going up and up and up and up and up and up. And I'm losing. What's happening with every tick of the market to my heartbeat? I am freaking out. I'm watching it go against me. I'm watching my profit and loss go down. I'm watching my account dwindling. I'm a non-smoker that's now a full-pack smoker, right? I'm a non-drinker that's now drinking, right? You know what I mean? I'm freaking out every tick it goes against me. Oh, my goodness. Lose, 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 lose. Please come back. Please reverse. Oh, wait. It's going against me, going against me, going. Oh, look, this down close bar. Okay, now it's coming back in my favor. Oh, thank goodness. Thank goodness. Oh, good. Oh, no. Now it's going back, right? I jokingly say I'm a non-smoker that's now smoking, right? I'm non-religious that's now praying, right? It's stressful. If I'm trading a spread, I buy it right here. I think it's going up. I'm wrong. It's going down, 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 down. Okay. Am I stressing? Am I freaking out? No. I know before I press enter, I know exactly the maximum that I can lose, right? It's not a question. I know it because, for one, I know how spreads work. For two, I saw it right there on the Nadex ticket before I ever pressed enter. Okay, I want to sell one. Boom. The max I can lose is 13. Okay, place order. $13 will come out of my balance and be put on hold to place that order. When I exit the order or when the spread expires, whatever the difference is goes back into my account or doesn't, right? I know ahead of time exactly. So it's not only is my risk capped, but my risk is known up front. The amount I have to put up for the trade is known up front. I don't have a lot of stress, do I? If I'm trading futures, for example, and I don't have a stop order, and I want to go sell, but it goes up against me, and I don't close it, do I know what my maximum risk is going to be? No, I don't know where the market's going to go. It could just go and go and go and go and go. That's right. But I know exactly ahead of time what my risk is on a Nadex spread. But I get to trade an instrument that mimics and kind of mirrors the underlying market, right? Hey, it sounds cool to trade spot forex, and as the market goes up every tick, I'm making I'm making money every tick. As the market goes down a tick, I'm making money every tick, right? You can mimic the market, but some people say, hey, I don't have, tons and tons of money to put up, to trade spot forex, or I don't have a larger account to put up to trade live futures and, trade the S&P and the NASDAQ, okay? But could I put up a little bit of money on a Nadex spread, knowing exactly what my floor and ceiling are and mimic the market like that? Okay, that's great, right? Okay, so quick question though. If I buy at 24.10, the market goes against me, how much am I down? $10. But is my trade closed out? Is it like, oh, done, oh well? No, the trade is still open unless I close it or it expires. So it goes down against me, but then what does it do? It comes back up, and it comes back up, and then what does it do? It goes all the way up here. Boom. I got all the way to max profit, right? So do you see how that's very beneficial? That it doesn't automatically just close you out because it hits a top or bottom. How many of you have ever entered a trade, right? Okay, I'm going to buy right here for it to go up. But if I'm wrong and the market goes down here, I need to have a stop and like get out of that trade because I don't want to lose more than X amount. Everybody understand what that means, right? By a stop, like, okay, I'm going to buy, but if it goes wrong against me, I want to get out down here to limit my loss. Okay, so show of hands. And if every single one of you don't show your hands, I know you're lying. How many of you have bought to say it's going to go up, but it goes down, hits your stop, closes you out of the trade, you lost money, and then a few minutes later it comes back in your direction and, oh, you were right. And you're like, man, the market did that to me. I'm convinced that it's a conspiracy theory. The whole world out there, every other person in the world, every trader and bank in the world knew exactly that me, John Skelton, was placing that trade, and they knew where my stop was, and they came just to get me, right? You start becoming a conspiracy theorist, right? And think everyone's out to get you. But you're like, man, I was right. I was right. I called it right. I said the market was going up, and it went up. I just needed a little more time to be right, and I just need a little more room to be right. So what happens is you buy here thinking the market's going up, but it makes this little quick move down, and you get stopped out and you lose money. And then when it comes all the way back up here, so you're like, man, I could have been right and made all this money, but instead I ended up losing money. Okay? Do you see how powerful it is with a Nadex spread? Because you buy right here, You have very limited risk. The market can come down against you. Oh, well, then, and it doesn't just automatically close out the trade. The trade can come back into the spread and go up, and you can make money. It gives you a little more time to be right. Okay, does that make sense? Cheryl, I'll get to that in just a second. Okay, now, but here's something you have to keep in mind. The opposite is true as well. So it comes all the way up here, and it comes out of here. Am I really worried that it went from here to here? Am I making any money from here to here? No, because I'm only making money up to the ceiling. So just like it didn't close your trade out automatically when it goes against you at the floor, guess what? It's also not going to close your trade out if it goes all the way to the ceiling. So what happens? Oh man, the trade went against me. Oh well, oh great, look, oh, it's coming back. Now we're going up, we're going up, we're going up. I'm excited, I'm excited. Bam, I got all the way up here to the ceiling. I made the maximum profit I could off this trade. Man, I'm just gonna sit here. And then wait, what does it do? Oh, it comes about, oh no, it comes against me. Okay, no, we're good, we're good. Then what happens? Oh boy, bam, all the way back down here. And then what are you thinking? Oh man, I could have made all that profit potential when it went to my max profit level, but I didn't close the trade out. And it came all the way back against me. Oh man. Okay, look, oh, it comes all the way back up. Great, but I don't close it out. Okay, then it expires right here at 24.90. Boom. So let's say that happened. We just let it go till expiration, and it expired right here at 24.90. Well, I bought it 24.10. It expires at 24.90. What's the difference between 10 and 90? 80. Okay? And if it's $1 a pip, $1 a tick, then how much would I have profited on that trade? 80 bucks. Okay? But what if I'd bought here at 24.10, it came all the way up to my max profit, and I could have just closed it out for max profit, right? But I didn't do that, and it came all the way back down here to 24.30, and it expired. So I bought it at 24.10. I didn't exit when I could have made the most, and it expired at 24.30. So I only made 20 bucks. Okay, so everybody get that. You understand why it's so powerful that it doesn't just close you out when it goes outside. Okay, that way it leaves you room for if the market comes back in your favor. But you got to understand it automatically does not close you out just because it hits your max profit. You need to close it out. So the trade does not close just because it goes outside the box. It closes when you close it or when it expires. Okay, makes sense? Okay, so let's just move along here a little bit. I know I kind of went over that a lot, but you really have to get that. You really have to get those basics there, okay? So there's all kind of different spread expirations, all right? You've got intraday spreads that are as little as 2 hours. You've got dailies that are up to 22 hours and 15 minutes. Larger time frames will be wider between the floor and the ceiling. Shorter time frames will be narrower, okay? For example, you have spreads that overlap. Let's say on a particular market, at any point in time, let's say you've got a huge spread that expires at the end of the day, okay? And it might be a huge spread that has a ceiling at 32.50 and a floor at 27.50. It could be a 500 tick spread that goes all the way till the end of the day, okay? You might have hours and hours to go on that spread. Obviously, if you have a 500 tick spread and you're getting in somewhere in the middle and you want to buy to go up, well, if I'm getting in at the middle of this 500 tick spread, how many ticks do I have to the floor? I've got like 250 ticks to the floor, right? So my max risk is 250 bucks, which means I have to put up out of my account how much to get in that trade? About 250 bucks, right? So it will show max loss 250 bucks on the ticket. Now, does that mean I'm going to sit there and let the market go against me $250, 250 pips? No. If I'm wrong and it goes 20 or 30 against me, I'm just going to close it out, right? So my real, planned and managed risk is still only about 20 or 30 bucks, right? So just because I have to put up more to get in a particular trade, does that really mean, okay, and we're going to go over this more next time. I don't want to spend a lot of time on it, okay, because we're about to finish up here. But if I look at one of these spreads here that go till 3 o'clock, right? And let's say I'm looking at this spread right here, and I want to, or no, let's see here. Say this one. And let's say I want to buy this spread. Okay. Oh, no, not that one. I'm sorry. 1-0. Well, the market's moved quite a bit here. 117. 1117. Let's see about this one here. Okay, so let's say I wanted to buy this spread right here. My max loss, $44. Okay, so I want to buy it. I think it's going up. But let's say I'm wrong and it starts to go down. And let's say it goes down against me 20, 25 pips, 25 ticks. I might go ahead and just get out of it, right? Okay, I'm wrong, it's going against me, right? So it says max loss $44. But maybe with my system, if it goes against me 20, 25, I'm going to get out anyway, right? So if it went against me 20 and I got out of it, how much would what would be my loss? 20, right? Because with my system, if it goes against me 20, I'm just going to get out. So even though my max loss was 44, I managed the trade and I just got out when it was only down 20, right? So yes, I need to pay attention to what these numbers say, but just because it says max loss 44 doesn't mean that's what I'm going to, manage the trade as. I might get out of it if it goes against me 20, right? Everybody get that? Make sense? Okay, so if I hop over here to the end of the day and to one of these bigger, wider spreads, look at this spread, 20,600 up to 21,000. That's a 400 tick spread, right? Yeah? Everybody see that? And let's say I look at this spread and I say I want to buy this spread. Whoa, max loss 321. Well, why does it say 321? Because it's a big spread and I'm buying up towards the top of the spread. Oh, forget it. I'm never getting that spread. That risk is too high. Is it? If I'm still managing my trade the same way, and if I'm wrong and it goes down against me 20 or 25 and I close out, how much would I lose? How much would I have lost if I got this spread, it went against me 20, and I got out? It's still 20, whether I put up $40 to get in that trade or $321 to get in that trade. So yeah, I have to, have that amount of money in my account to set aside to enter the trade, but my risk, my managed plan risk is not any different. All right, does that make sense? So don't be, you know, so you have to look at it that way. And we're going to talk about that more next time. Okay. All right, guys, I've got a lot more I'd like to cover with you here, but we're running out of time. But, you know, there's a ton of different expirations. I mean, right now, just as of right now, if I pull up the Wall Street 30, which is the Dow, you know, we had spreads that opened up at 12 p.m. and went to 2 p.m. Okay. And for example, each of those, oh, well, those are expired now. You know, we had spreads that, no, they're not. There we go. You know, and these spreads are what? 50 to 1. These are 100 pips, 100 ticks wide each. Okay. Now, we have some spreads, and we're going over here, but I'm purposely trying to drag this webinar on a few more minutes because I want to show you something, and then we'll finish up because I want you to see this live. So we had some spreads that opened from 1 p.m. and they expire at 3 p.m. Okay. Now, here in just a second, it's going to be 2 p.m. And we're going to have some spreads that go from 2 p.m. to 4 p.m. Okay. So these spreads from 2 to 4, okay, they just opened up, right? And we've got floors and ceilings, well, okay. How does this work? All right. And, you know, how does this work? How are the floors and ceilings determined? Okay. Well, who can tell me what market are we looking at here? This is the Wall Street 30, which is the Dow. Okay, let me pull up a quick Dow chart. And this is the last piece I'm going to leave you with, and we're going to finish up. But this is very important for you to understand. Okay. Let me pull up a Dow chart. Somebody asked earlier, well, how are the floor and ceilings determined? You know, are these just random people out there making floors and ceilings? Or if the market's going up, then they put a floor here and, you know, a ceiling here? No. All right. Here's how it works. Very simple. When these new spreads open up, whether it's the dailies or the intradays, or, all right, it's determined on where is the market at. So, for example, these that just opened up right now at 2 o'clock, they go from 2 to 4. Well, at about 1:58, all right, it's a matter of where is the market at? Where is the indicative at? Okay. And you notice right here, right now, the indicative's at 21,120. Okay. So right before 2 o'clock, they're looking to see where is the market at. Okay. And it was right around 21,125. How do I know that? Well, for one, you see on the chart right here that we've got a little bit of a bar going down. So it's at 21, it's at 120. But right before the top of the hour, it was up here closer to 25. See it? Everybody can see that. But also I can tell you that because look at these middle 3 spreads. So these particular 2-hour spreads, everything's a little different, but these particular 2-hour spreads, how wide are these spreads? From 21,025 to 21,125, floor and ceiling. That's 100 pips, right? 100 ticks. So right before 2 o'clock, the market's right around 21,125. How do I know that? Because, boom, this spread, look at these middle 3. Okay. They give you a top and a bottom to just go a little extra, but look at the middle 3. 21,125 is the ceiling of this spread, right? That's the top of the spread, and it goes where? Down 100 ticks. Everybody see that? Right? Look at this spread. The same number. 21,125, and it goes where? Up 100 ticks. Okay? So I think everybody's starting to get it now, right? And see where I'm going with this, right? It's not some random person or random something picking random floors and ceilings. It's not twisted in, you know, one side's favor over the other, whether the market's going long or whether the market's going short. Okay? It's where was the market? So right there at 2 o'clock, okay, the market was where? 21,125, right? So what do we get? All right, so 21,125. So we get a spread with a floor or a bottom at 125 going up 100 pips, right? 100 ticks. Well, and then they give you another spread where 21,125 is the top of a spread or the ceiling of a spread going down 100 ticks, right? And I'm not drawing this down 100, obviously, but there we go. Does that make sense? And then what do? Then they give you another one that's right in the middle, where 21.25 is where the market is right there. So it goes up 50 and down 50. So you've got some different options there. Does that make sense? And notice, remember, 21,125 is the top of this one going down 100. 125 is the bottom of this one going up 100. And then what's right in the middle? 75 to 175, which is where? Right in the middle. Then they give you an extra one at the top if it keeps going high and an extra one at the bottom. Okay? So Randy, did that answer your question from earlier? Okay? All right. Good, good. Okay. Well, guys, we went over a little bit here. I just wanted us to purposely go over the top of the hour so that you can see those new spreads live to see exactly how that works and how those are determined. Okay, so that is the quick run through of the basics of Nadex spreads. And make sure to join us on the next webinar where we're going to talk about, some common mistakes that people make with trading spreads. We're going to get a little bit more into, okay, so we've got these different spreads out there. We've got different floors and ceilings, and we've got different pricing on each of them. Okay, some of you say, well, hey, I bought a spread and thinking the market's going up. The market did go up, but I didn't really make any money. Why? It's supposed to be $1 a pip, right? Well, also you have to realize, look at these different prices here. There's all kind of different prices that you can buy in for, right? Which is going to affect what you make when you get out of it, and also based on the different floors and ceilings. So we built the foundation today. You have the basic understanding of spreads. Play with them, look them over, throw some demo trades on them. Join us next week when we dig into all the different options and which spread, is the best one to choose from based on your strategy or system, which ones move faster, which ones move slower, and talk about some different risk to reward ratios. Okay, so make sure to join us next week on the webinar. And once again, this webinar is being recorded and will be posted there on the site. Okay, so guys, thank you so much for joining us. Have a great trading week, the rest of the week here. Have a great weekend. We look forward to seeing you next time. Thank you so much. Thank you for your interaction and your great questions. You're very welcome. Hope this was thankful. Have a great one, guys.